Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, the founder of MoneyMagpie. And before I start, first thing I have to say is, firstly, nothing that's said today should be taken as financial advice. I always have to say that it's just fact. And secondly, make sure that you are following us, subscribed, and do comment. We're very interested in your comments. I always read the comments and I reply to them. So do give your thoughts in the comments. So that's out of the way. Today, I'm very pleased to say that I'm joined by the independent economist Julian Jessop, who knows about all kinds of things to do with the UK and world economy. Julian, hello there.
Hello there, thank you.
I'm just hoping we're going to have enough time to cover everything,
Mm.
frankly. But what I was particularly wanting to talk to you about, and this is from the point of view of an investor, of course, is the Trump effect, which we've had for
Mm.
a few months now. It's going up, it's going down. Seems to be a little bit on a happier level at the moment, certainly globally. What would you say is the current state of the Trump effect across the world in terms of trade and in terms of tariffs?
Mm. Well, initially, of course, the Trump effect was very negative. We had the big falls in stock markets at the beginning of April when Trump announced these enormous tariffs on imports from the rest of the world, much bigger, I think, than anybody had been anticipating. But since then, the markets have gradually recovered, and that's partly because Trump has been doing deals with some countries and also edging towards deals with others, particularly China, the most important player in any global trade war with the US. So there are some signs that this uncertainty is lifting, and some of the worst fears about a global recession being triggered by a trade war have faded. There's still plenty of uncertainty out there. You know, Trump is not entirely consistent from day to day. I sort of turn on my screen every morning and think, oh no, what he might have said overnight. But I think that we are heading towards a position where the US will do deals that leave tariff barriers a little bit higher than they were a few months ago. So that's bad news. But we're not going to get the global trade war that people feared, and people can, return to worrying about more normal day-to-day things in their own economy.
And of course, the trade deal that has been done with the UK, for a start, it's amazing that it was basically the first one. And it
Mm.
was, to me, it was quite a pleasant surprise to find that I felt we'd kind of got away with it a little bit, certainly compared to the EU, compared to quite a lot of other countries. It didn't seem too bad. Am I right in thinking that, or were you actually not impressed by it?
Well, it wasn't a massive deal. It only affected some of the higher tariffs that are being imposed on things like cars and steel, and frankly, those were probably going to come down at some point anyway. But I think it's an important step in the right direction, and it's also encouraging, of course, that the UK for once was first in the queue rather than at the end of the queue. So those people describing it as a Brexit win, I think that's a fair thing to say as well. So it was a small step in the right direction, but the direction of travel is the thing that matters. So we're not going to be hit by some of the higher tariffs that we might otherwise have done. It also was a good deal in the sense that it didn't compromise our ability to do trade deals with other countries either. There's always a risk that if we end up with a big comprehensive deal with one country, then you have less freedom to negotiate on tariffs or regulations with others. But because this was a relatively limited deal, that was actually quite helpful in leaving us free to negotiate other different deals with other countries, including the EU. We still have plenty of flexibility to hopefully get a better deal than we've got at the moment with them as well.
Yes, I'm going to ask you about what this means to investors in the UK, but you mentioned the EU, and I'm just wondering, does this mean that possibly companies in the EU that do a lot of deals, do a lot of trade with America, might possibly relocate to the UK because you have better tariffs and all that kind of thing?
Yeah, the UK is actually standing out at the moment. It's a bit of a safe haven from almost everything else that's going on in the rest of the world. So we seem to have positioned ourselves quite well, somewhere between countries like the US and India on the one hand, and the European markets in the EU on the other. So we're quite well positioned, I think, for companies that want to trade well with both. We are currently benefiting from lower tariffs on some important goods, including things like cars and steel. I suspect that the European Union will get a similar deal at some point in the future. So companies might be reluctant to take the risk of moving lock, stock, and barrel to the UK now. But I think this fits in with this broader picture of the UK being a country that, by and large, can sit above the sort of global trade war fears and benefit from things like better regulation, particularly of some of the cutting edge sectors like AI. I think that's an area where we can sort of follow the more sort of light touch US regulation rather than EU regulation. And therefore, that would be an attractive place for any company that's got interest in AI or wants to use AI.
Maybe for Bitcoin as well. I'm a Bitcoin fan, and I mean I'm deeply unimpressed by the way the FCA seems to be approaching Bitcoin, and therefore banks and other financial institutions going, oh no, not
Mm.
Bitcoin, don't touch it. But it seems to me that it has a future, and Britain could be the place to where it could bed itself down.
Mm. Um, I'm not so sure personally about Bitcoin. You know, I tend to think it's a bit of a punt rather than an investment. But equally, I recognise anybody who has punted on it has done extremely well. So fair play to them. But there is a more general point about the financial sector here. That is an area where there's definitely been some Brexit benefits in terms of more sensible regulations, lighter touch where appropriate, but more sensible across the board. And I think a lot of, financial services companies will be looking at London as still being by far the dominant financial centre in Europe and, neck and neck with New York in particular in most global surveys. So, the financial sector is one where I think we have already made big gains since leaving the European Union. Long may that continue.
So I'm picking up a cautious sense of optimism from you for the
Mm.
UK as an investment centre, as a place that investors could consider putting their money. Am I right in thinking that?
Yeah, I think that's right. I mean, first of all, if we simply look at the economy, I think actually there's a bit too much gloom about the economy at the moment. The obvious big downside risk globally was the fallout from a trade war, and those fears haven't evaporated completely, but they are fading. If you look at the UK economy itself, there are actually some signs of life, particularly in the consumer sector. So retail sales data have been strong. There are lots of reasons for people to be nervous, but the reality is that most people are still seeing their incomes rise faster than prices. So real incomes are increasing. They've got spending power. And unemployment, although it's edging up a little bit, is still relatively low. So I think once we clear the current uncertainty, the global trade wars, and also the immediate impact of the big increases in labour costs that kicked in April, I think the second half of this year might look quite a bit better than people have been anticipating. I'm still not expecting stellar growth, but maybe the economy might grow by 1.5%, which isn't brilliant, but actually it's a lot better than many of our peers in Europe in particular, and doesn't have all the sort of additional political uncertainty that comes with investing in the US under Donald Trump. So I think the UK might stand out as a market that does relatively well.
Well, that's music to my ears, particularly when one thinks of the government's demands, it seems like, or suggestion, encouragement, I don't know what you'd call it,
Mm,
that pension funds invest in the UK. I mean, I'm 50-50 about this because on the one hand, I think, well, it's good to support your own country, it's good for us to buy British, but on the other hand, who are they to tell us where we
mm,
should put our money? I don't want to be told. I'd like to, I have a SIP. I put my money where I think it should
mm.
be. Um, what do you feel? Does this mean that actually it's quite a good idea then that actually investing in Britain is a good move right now?
Well, I am worried about the approach that this government is taking, which is basically to intervene everywhere it can. So we've seen that in the energy markets, for example, with the rush towards net zero. We've seen it in the labour markets with the big increase in payroll costs and now additional red tape through the so-called Employment Rights Bill. And now possibly we're seeing it in asset markets as well, with the suggestion that pension funds will be forced to invest up to 10% of their assets in what are called private markets. So these aren't sort of straightforward UK equities. They are unlisted assets like infrastructure funds and private equity. Now, as it happens, I think there is a reasonable case for funds investing a proportion of their assets in these sorts of investments. And 10% in total may not be unreasonable for a long-term pension fund. But my angle on this is that if this is indeed a good investment that's appropriate for the people that investing in these funds, then the fund managers should be free to decide that for themselves, with the approval of their trustees. I don't really see what the role for the government is. And more generally, if you want people to invest in an asset or in a country like the UK, the best thing you can do is make that place an attractive place to invest. Get the fundamentals right. Light touch regulation, low taxes, all those sorts of things. You shouldn't be forcing people to invest in your country, and that's not really a sign of strength. If anything, it's an indicator of weakness. So I've got nothing against funds choosing to invest more in private assets, including in the UK. But I think that should be their decision, not something imposed by the government.
I mean, you're mentioning light touch regulation and low taxes. I think it does feel like we have a lot more regulation than we used to, but as you've mentioned, it's less than the EU, which is phew,
Mm.
that's a relief. Low tax rate, it doesn't feel like it. How do we fare taxation wise compared to I mean, other Western countries?
Oh, well, it's a huge mix. I think there are sort of three dimensions here. I talked about low tax, but there are two other dimensions as well. One is the simplicity or otherwise of the tax system. And the third thing is the certainty or predictability around it. Now, actually, in terms of the level of tax, we don't particularly stand out. There are plenty of countries in Europe that have higher levels of tax and government spending than we do. Admittedly, they're not always doing better in economic terms. France being a good example of a high tax, high spending, high regulation economy that actually is doing worse than ours. But it's those sort of second two dimensions that worry me just as much. So our tax system is incredibly complicated. There are lots of examples where if you earn just a small amount of additional money, you end up spending almost all of that additional income in tax, or maybe even more. You actually end up losing money if you work just that little bit longer. And the other dimension is the lack of certainty around the tax system. So over the last few years, national insurance has been up, down, up again. Corporation tax regime is always being changed. We have so-called one-off windfall taxes that actually are not one-offs at all. They're being extended and increased and added on to different types of activity. So we suffer from sort of all three problems. The tax level is too high. But also the tax system is too complicated and too uncertain, and that's definitely holding back investment and entrepreneurship and discouraging some people from working you might otherwise have done.
Is there any way that we can simplify it? Because I mean, all of my career, I've heard people saying we really need to simplify
Mm.
the tax system, and it just gets bigger and bigger. I mean, I've seen the books are so that big, that have
Yeah.
all the tax rules. Is there any way that one can do it?
Well, there are a number of things. I mean, first of all, if you think about the level of tax, then what we need, of course, to match that is lower government spending, and also stronger growth, so that we raise more tax revenues, but without having to raise tax rates, and might even have scope to cut them. And there are lots of things the government could do there. I'm thinking in particular of improving public sector productivity, which has been poor for decades, well before the current government took over. We could start fixing the productivity puzzle in the public sector, then we could actually do more with less, and that would allow taxes to be cut. In terms of the complexity of the tax system, actually, there are lots of things that I would like to do as an economist that I know politicians would never do in practice. So, for example, I would unify income tax and national insurance. That would create a much simpler tax system, but it would mean that the income tax rate is higher. Because it would have to pay for the disappearance of national insurance. I'd also do things like extend VAT to things like food and children's clothing, which again would I think makes sense, but would never get me elected. So
It
I
wouldn't.
recognise that's unrealistic. But what we can do is look at some of all the sort of complicated allowances and bells and whistles within the tax system that we could get rid of. And in terms of the certainty around tax, I think we should be in a position to be able to say that these are the tax rates, and we're not planning to make any big changes. So in particular, if we had some taxes that we introduced that we promised were only going to be temporary, like the windfall tax on energy companies, we should say for certain that that is going, rather than leave companies guessing.
So finally, Julian, we are talking about investing, of course, and we've talked about
Mm.
the British economy. What about the FTSE? What about the British
Mm.
stock market, which is, let's be honest, it has a huge amount of companies from well outside the UK. It doesn't necessarily reflect the UK itself. And for the last few years, the S&P 500 has been the place to
Mm.
put your money if you wanted to track a fund. Is the FTSE, do you think, something that the FTSE 100, the FTSE All Share, the mid caps, are any of those a place to put your money now, would you say?
Well, you're right to talk about the UK market being a bit unusual. And I always think of the UK market actually being basically two markets. There's the FTSE 100, the bigger, often global companies, which I think should do relatively well because they're exposed not just to the UK economy, but also globally. They have underperformed the US market over the last few years, but then almost everybody has because the strength in the US market has been limited to, the handful of big tech companies, the so-called Magnificent Seven, that have done relatively well. So I'm a bit concerned that with the US market looking overvalued and highly dependent on just a few stocks, if you're looking for exposure to the global economy, then actually the FTSE 100 isn't a bad place to look because lots of companies there do make lots of money outside the UK as well as in the UK. If your motivation for investing in the UK market, though, is more your optimism about the UK economy itself, then you might look at the FTSE 250. So, the indices that include some of the smaller companies that are more dependent on the UK. So, I think it depends on your motivation for being more positive about the UK. If it's because you think the UK will do relatively well in an environment where the global economy is doing better than expected, then maybe the FTSE 100. But if you're really bullish on the UK itself, then look at some of those smaller companies that are in the FTSE 250.
Great. Thank you very much indeed. This is Julian Jessop, independent economist. I'm Jasmine Birtles. I'm the founder of MoneyMagpie.com. This has been the Money Magpie Invest podcast. As I said at the start, like, follow, share, tell all your friends you know you want to, and comment because we're always interested in your comments and what you think. And do tell us what you think about what Julian said and about the UK economy. And I'll see you next week.